Welcome back, learners, to the course on Essentials of Financial Management. This is week 4, lecture number 17, Degree of Financial Leverage. If you could recall, in lecture number 16, we started with the concept of financial leverage and the impact of financial leverage. Here, in lecture 17, we are going to discuss about what is degree of financial leverage, significance of financial leverage, and what are the limitations of financial leverage. So, what is degree of financial leverage? It is a financial metric that measures how sensitive a company's earnings per share are to the changes in operating income, that is EBIT. So, when we talk about the degree of financial leverage, we are just focusing on how sensitive a company's EPS is to the changes in the earnings before interest and taxes. So, if we change the EBIT, what impact it is going to have on the earnings per share. Degree of financial leverage shows the percentage change in EPS for every percentage change for every 1% change in EBIT. A higher degree of financial leverage indicates greater volatility in EPS due to changes in operating income. So, it basically says what is the change in earnings per share for 1% change in EBIT. So, if a company has a high degree of financial leverage, so there is a greater volatility as far as the EPS is concerned or the change in EPS is concerned with respect to change in the operating income of the company. It helps companies assess the risk associated with using debt financing. A high degree of financial leverage means that even small change in operating income, that is EBIT, can lead to significant fluctuations in earnings per share, which can impact shareholder confidence and stock price. So, it basically means that if a company is having a very high degree of financial leverage, a small change in the operating income, a small change in the earnings before interest and taxes can lead to a significant fluctuation, can lead to a significant change in the earnings per share. And if this is the case, the shareholders' confidence might be affected and the stock prices might also go down if the EPS is so sensitive to the changes in the EBIT. Okay. So, we have few formulas for calculating the degree of financial leverage. So, the formula number 1 says that degree of financial leverage can be calculated as percentage change in EPS, and if we divide this by percentage change in EBIT, so we can calculate the degree of financial leverage. We have already discussed this in the this slide also. Formula 2, it says that we can also calculate degree of financial leverage as if we use EBIT and we divide it by EBIT minus interest expenses, or we can say that EBIT minus I. We can write it as formula 2 as EBIT divided by EBT. So, earnings before interest and taxes is divided by earnings before taxes. This is the formula 2 for calculating the degree of financial leverage. Now, let us understand this through an example. Company A has a degree of financial leverage of 2. So, it is given. This means that for every 1% change in its EBIT, its EPS will change by 2%. It is clear? If its EBIT increases by 10%, its EPS will, so this is a favorable thing. However, if EBIT decreases by 10%, its EPS will also decrease by 20%. So, this is a concern here. So, EBIT, there is an increase of 10%, EPS will increase by 20%, that is very good. But if EBIT goes down by 10%, the EPS will also go down by 20%. So, this is the risk. Degree of financial leverage, right. So, high degree of financial leverage, it indicates a company is using a lot of debt financing. This can lead to higher potential returns for shareholders if the company performs well, but also higher risk of losses if the company struggles. So, if a company performs well, a company is having a high proportion of debt, a company is having high degree of financial leverage. So, in that case, if there is a high potential for returns, so and company is performing well, so that is fine. But in case there is a risk of loss also if the company struggles, the company is unable to generate sufficient amount of returns. Low degree of financial leverage, it indicates a company is using less debt financing. This results in lower potential returns, but also lower risk. A company which employs lesser amount of debt has a lesser amount of financial risk. It has a lesser potential for generating returns, but again the risk is also less in that company. What are the factors that affect the degree of financial leverage? First is the amount of debt. If you look at the formula, right, if there is more debt, that means you are paying more interest payment, right. So, if interest expense go up, therefore, this fraction, that is degree of financial leverage, will increase. So, if the company employs more debt in its capital structure, the degree of financial leverage will go up. And the next is company's operating income, that is EBIT. It is clear from the formula, if you increase the EBIT, obviously the degree of financial leverage will also increase with the increase in EBIT. So, either company can increase its EBIT, or if company employs more debt and pays more, in that case more interest. So, in that case this EBT will reduce, obviously DFL will increase. So, what are the important considerations? Degree of financial leverage is just one metric to assess a company's financial risk. It is important to consider other factors such as company's industry, its financial health and its overall risk tolerance. So, DFL is just one of the metrics or measures which the company uses to see the financial risk the company has, but it is not the only measure. Apart from this, there are other measures also which the company should take into consideration. So, what are those measures? First thing is to consider whether in which industry the company belongs. So, looking at the industry also important. Is it a cyclical industry? Is it a non-cyclical industry? Right? Its financial health and its overall risk tolerance, the proportion of debt the company has taken and the ability to use that debt in a profitable way. Degree of financial leverage can vary over time as company's capital structure changes with time. We know that degree of financial leverage is directly related to the capital structure of a company. Higher the proportion of debt, higher is the degree of financial leverage. As the capital structure of a company is not constant, it changes with the passage of time depending on the usage of funds, the requirements of funds, right, the amount of risk that the company is willing to undertake. So, the degree of financial leverage is also bound to change with the passage of time. What is the significance of financial leverage? Right. First one is amplifying returns. We have already discussed this in the previous lectures also. It increases or magnifies the return for the equity shareholders, because whatever you generate from the fixed interest bearing securities, that can be shared with the equity shareholders, and because of this the return on equity increases. We will discuss this with an example in the coming slides. Increasing investment capacity. It increases a firm's capacity to undertake larger projects which they could not have taken if they would have not gone for additional debt. Tax advantages. As you know, the interest that you pay to debenture holders, bond holders, that is considered as a tax deductible expense as far as the calculation of taxes are concerned. So, usage of debt minimizes tax liability for a company. Maintaining control. Unlike equity, when you issue equity, the existing shareholders lose control, but when you use more debt, when you employ more debentures, the stake or the control of the existing shareholders is not diluted, because debenture holders do not have voting rights, right. Planning the capital structure. So, it facilitates the planning of capital structure, and how? Ratio between fixed interest bearing funds and equity share capital is decided. What should be the debt equity ratio, right? What is the risk and return associated with different debt equity ratio, and what is the impact of leverage on the weighted average cost of capital and financial. Usually with increase in financial leverage, the weighted average cost of capital will go down. We have seen the capital structure theories in the previous week, and but we have to remember the financial risk also increases with the increase in the proportion of debt or with an increase in the financial leverage. Profit planning. It can be used to increase earnings per share if the rate of return is higher than the cost of debt. So, here we are talking about the favorable case of leverage. If the rate of return on the capital employed is higher than the required rate of return or the cost of debt, it will be a favorable case of leverage and company can use more of debt. On the contrary, if the rate of return on the capital employed is less than the cost of debt or the required rate of return, in that case it will be difficult for the company to make interest payments, and it has to make payments from their own pocket, which will have an adverse impact. In that case, the company should minimize the use of borrowed funds. Now, let us understand this with an example. A company raises rupees 1 lakh by issuing equity shares and invests the amount to generate a return of 30,000, right, rupees 30,000, that is 30% return on equity capital. It requires another rupees 1 lakh for expansion. It has two options to raise additional rupees 1 lakh. What are those two options? Let us say, considering both will fetch the similar rate of return. So, in both the options the rate of return is 30%. Option A, it raises rupees 1 lakh by issuing equity shares. So, already it has issued 1 lakh, now it issues another 1 lakh equity shares. Option B, it raises rupees 1 lakh at the rate of 10% by issuing debentures. This is plan A, this is plan B. Which option should company choose? So, this is the question that we have to answer. So, let us say if a company goes with option A, which is option A, it uses additional rupees 1 lakh of equity to raise fund. So, what will be the total earnings for the company in this case? 30,000 it generated on the initial equity that it had, right, this is the, and now it has again issued 1 lakh equity, it will generate 30% because it is mentioned that it will fetch the similar rate of return, right. So, the total earnings of the company is 60,000. The company makes an earning of rupees 60,000 on equity capital of 2 lakh. How it is 2 lakh? 1 lakh was the initial one and the company has issued 1 lakh after that. So, return on equity, that is ROE, is 60,000 divided by 2 lakhs, it is 30% if company opts for option A. Now, let us say if a company goes with the option B. What is option B? It raises 1 lakh debentures at the rate of 10%, right. Now, what will the total earnings in this case? 30,000 is because of the 1 lakh equity it had, and this 30,000 is on rupees 1 lakh of debentures. So, total earnings for the company is also 60,000 because it is clearly mentioned whether it goes with option A or option B, it will generate the similar rate of return, that is 30%. The company will pay an interest of 10% because it has issued debentures at the rate of 10%. So, it has to pay interest also. So, let us say it is paying an interest of 10,000 and this 10,000 how you calculate it? 1 lakh and you take 10% of that, that is 10,000, right. Now, the company makes an earning of rupees 50,000. So, 60,000 minus 10,000 you take out the interest payment, still you have rupees 50,000. And now, what is the equity capital here? It is not 2 lakhs, you have to pay attention, it is 1 lakh because additional 1 lakh has been raised through debentures. So, in plan B the company has an equity capital of only 1 lakh and it is generating earnings is 50,000. So, the return on equity in plan B is 50,000 out of 1 lakh, it is 50% as compared to plan A or option A where the return on equity was 30%, plan B return on equity is 50%. So, usage of debt has generated the return available for the equity shareholders, but as far as the total earnings are concerned, you see for both the options, option A and option B, the total earnings of the company is 60,000. There is only a difference in the share of earnings available with the equity shareholders. So, we can say that the capital structure does not has an impact on the total earnings of the company, but definitely it has an impact on the share of earnings available with the equity shareholders. Now, what are the limitations of financial leverage? Increased financial risk. As you know, when the company employs more of debt, it has to pay interest, and inability or if a company is not able to pay interest, then therefore, the risk of liquidation increases because the creditors will force the company to liquidate. Interest expense burden. High interest rates can reduce profits. If a company has borrowed funds at a very high rate of interest, although whatever profit the company makes, it has to pay interest and it will lower the amount of profits with the company. Constraints on future investments limits ability to take on new debt. So, let us say company has come across some profitable ventures where it can make investment, but let us say company has already a very high debt equity ratio. So, they will not be able to get further debt from the creditors because they are somehow concerned about the high debt equity ratio of the company. Impact on credit rating. It negatively impacts companies' credit ratings. If a company has a very high debt equity ratio, the credit rating agencies might rate the company as low as far as the credit rating is concerned. So, company should try to minimize the amount of debt in its capital structure. vulnerability to economic downturns, downfall in revenues and cash flows during recession. Whenever there is economic downturn such as recession or depression, in that case the earnings of the companies goes down and it gets very difficult to make regular interest payments. Double-edged weapon, favorable and unfavorable leverage. We have already discussed this with example that leverage can be beneficial, that is it can be favorable when the rate of return is higher than the cost of debt. But if the rate of return is lower than the cost of debt, it is a case of unfavorable leverage, and that is why it is known as a double-edged sword, that it can magnify the earnings, but it can also magnify the losses. We have also done some questions to understand this concept in the previous lecture. Beneficial only to companies having stability of earnings. So, financial leverage is beneficial only to companies which have stable earnings irrespective of the cyclical changes, right. Increases risk and rate of interest. So, as the proportion of debt increases, the financial risk for the company also increases and the cost of borrowing also increases. Restrictions from financial institutions. A company which already has a lot of debt in its capital structure, the financial institutions might impose certain restrictions in the form of loan covenants. What are those loan covenants? It can be asset related covenants, it can be liability related covenants, it can be cash flow related covenants, it can be control related covenants. You can refer to the previous lectures where I have discussed these concepts in detail. Now, let us do some questions to understand. XYZ company currently has an equity capital of rupees 40 lakhs consisting of 40,000 equity shares of rupees 100 each. The management is planning to raise another 30 lakhs to finance a major program of expansion through one of the 4 possible financing options. So, let us understand, the company already has an equity share capital of 40 lakhs and consisting of 40,000 equity shares of rupees 100 each, right, and it wants to expand, and for that purpose it requires another rupees 30 lakhs. Now, it has few options to raise this additional 30 lakhs. What are the options? The first one is entirely through equity shares. It raises this 30 lakhs by issuing equity shares. The second one is rupees 15 lakhs through equity shares of 100 rupees each, and the balance through, that is the remaining 15 lakhs through debentures at the rate of 8%. This is the second option. The third option is rupees 10 lakhs through equity shares and the balance, that is the remaining 20 lakhs through long term borrowing at the rate of 9%. You see, if you have a debt of 15 lakhs, the rate of interest is 8%. If you have a debt of 20 lakhs, the rate of interest also increases because the risk perception of debenture holders also increase with the proportion of debt and they will expect higher returns, right. The fourth one is 15 lakhs through equity shares and the balance any 15 lakhs through preference shares with a 5% rate of dividend, right. So, these are the 4 options with the company. The company's expected earnings before interest and taxes, that is EBIT, will be 15 lakhs. Assuming a corporate tax rate of 50%, you are required to determine the EPS and comment on the financial leverage that will be authorized under each of the above schemes. So, there are 4 plans. We have to compare all the plans side by side. We have to find out the earnings per share, and let us see which plan is the best one out of these 4 plans. So, calculation of earnings per share and financial leverage. Plan 1 is an all equity plan. Plan 2 is a combination of equity plus debt. Plan 3 is again a combination of equity plus debt, where it has more debt as compared to plan 2, and plan 4 is a combination of equity and preference share capital. Okay. So, first let us understand the number of equity shares. So, this is mentioned, the first one mentions the equity shares and the figures are in rupees lakhs. So, initially if you see, the company had 40 lakhs of equity capital. So, this mentions the 40 lakhs and then again it issues 30 lakhs through equity. So, total is 70 lakhs, right. In plan 2, initially it has 40 lakhs and then it issues 15 lakhs, the total is 55 lakhs. Plan 3 initially it had 40 lakhs, then it issued 10 lakhs, it has 50 lakhs. In Plan 4 initially it had 40 lakhs, then it issued 15 lakhs, now it has a 55 lakhs of equity capital. And now we can calculate the number of equity shares. It is given as rupees 100 each. So, you divide 70 lakhs by 100, you get 70,000, you get 55,000. You divide 50 lakhs by 100, you get 50,000. You divide 55 lakhs by 100, you get 55,000. Now, 8% debentures. So, Plan 2 issues debentures at the rate of how much? 8%, and it issues debentures worth amount of 15 lakhs. 9% long term borrowings. In Plan 3, it issues 20 lakhs of debentures at the rate of 9%, and 5% preference shares. In Plan D, it issues 15 lakhs of preference share capital where the rate of dividend is 5%, right. So, now we can go to earnings before interest and taxes. It is given, it is 15 lakhs in all the 4 plans. So, what we do first? We start with deducting the interest payment. So, we deduct the interest on debentures at the rate of 8%, and we have mentioned this by I1 because there are 2 instances where the company is using interest. The first one we have mentioned it with I1. So, Plan 2 is using or issuing 15 lakhs of debentures at the rate of 8%. So, it comes out to be 1,20,000, and in Plan 3, that is issuing, it is borrowing how much? It is borrowing in Plan 3, it is borrowing 20 lakhs, it is borrowing 20 lakhs of debt at 9% rate of interest. So, 20 lakhs into 9% comes out to be 1,80,000. Plan A, Plan 1 and Plan 4 do not have any debt. Now, earnings before taxes, that is EBIT minus interest, we can calculate. For Plan 1, it is 15 lakhs, for Plan 2, it is 13,80,000, for Plan 3, it is 13,20,000, Plan 4, it is 15 lakhs. Taxes 50%. So, for Plan 1, it is 7,50,000, Plan 2, 6,90,000, Plan 3, 6,60,000, Plan 4 is 7,50,000. What is earnings after taxes? It is 7,50,000 for Plan 1, 6,90,000 for Plan 2, 6,60,000 for Plan 3, 7,50,000 for Plan 4. Now, again, when it comes to the payment of preference dividend is paid after the payment of taxes, whereas interest are tax deductible and they are deducted before the payment of taxes. We already done so many questions on these, I think it should be clear by now. So, less preference dividend, and what is the dividend rate? It is 5%. So, Plan 4 uses preference share capital of 15 lakhs, so it comes out to be 75,000. So, what are the earnings available for equity shareholders? We have to deduct the preference dividend. So, there is no change in Plan 1, 2 and 3, but in Plan 4 you deduct 75,000 further, it comes out to be 6,75,000. Number of equity shares we have already calculated. Plan 1 70,000, Plan 2 55,000, Plan 3 50,000 and Plan 4 55,000. If you remember, we have calculated all this initially. Now, we can easily calculate earnings per share by dividing earnings available for equity shareholders by the number of equity shares. For Plan 1, it comes out to be rupees 10.71, Plan 2 it is 12.55, Plan 3 it is 13.20, Plan 4 it is 12.27. We can also calculate the degree of financial leverage, which is EBIT divided by EBT. So, 15 lakhs is the level of EBIT and EBT is again 15 lakhs. So, this comes out to be 1. In second case, it comes out to be 1.087. In third case, it comes out to be 1.136, and in fourth case, it comes out to be 1. So, if you just compare, since the EPS as well as degree of financial leverage is highest in Plan 3, it should be accepted. The company should raise rupees 10 lakhs through equity shares and the balance of rupees 20 lakhs through long term borrowing at the rate of 9%. So, if you see Plan number 3, if you compare EPS, it is the highest in Plan 3, that is 13.20, and even you see the degree of financial leverage is also highest in this case. So, company should be preferring plan number 3, where it should issue or raise rupees 20 lakhs through long term borrowing. Plan 3 says what? 10 lakhs through equity share and the remaining 20 lakhs through long term borrowing at the rate of 9% interest per annum. This is the best plan for company as far as the EPS is concerned, right. So, company should go with plan number 3. Okay, let us do one more question. ABC Limited needs rupees 10 lakhs for expansion. The expansion is expected to yield an annual EBIT of rupees 1,60,000. In choosing a financial plan, ABC Limited has an objective of maximizing earnings per share. So, what it likes to do is it wants to maximize its EPS. It is considering the possibility of issuing equity shares and raising debt of either 1 lakh, 4 lakh or 6 lakh. There are 3 instances, right. The current market price per share is rupees 25 and is expected to drop to rupees 20 if the funds are borrowed in excess of 5 lakhs. So, if more of debt is used, so the risk perception of equity shareholders might also increase and it might lead to the reduction in the market price of the shares also. It might drop from 25 to 20. Now, funds can be borrowed at the rates indicated below. If the firm is using 1 lakh of debt, it is available at the rate of 8%. If it is between 1 lakh and 5 lakh, that is, it is over 1 lakh and it is up to 5 lakhs, the cost of debt increases to 12% because the risk perception of debenture holders also increase with the more usage of debt in the capital structure. And if the proportion of debt raises to 5 lakhs, if firm uses more than 5 lakh of debt, that is the third case, the cost of debt increases to 18%. The risk perception of debenture holders is further increased. Assuming a tax rate of 50%, determine the EPS for the 3 financing alternatives and suggest the scheme which would meet the objective of the management. Okay. So, here are 3 plans. Plan 1, where the company is using a debt of 1 lakh, plan 2, where the company is using a debt of 4 lakh, and plan 3, where the company is using a debt of 6 lakhs. So, we start with the EBIT. EBIT is 1,60,000 in all the 3 plans. Then we deduct the interest. In plan 1, the company uses 1 lakh of debt at a rate of 8%. So, it is paying 8,000. In plan 2, it is using 4 lakh of debt at the rate of 12%. So, it is paying 48,000 as interest. In plan C, it is using 6 lakh debt at the rate of 18%. So, it is paying 1,08,000 as interest. So, earnings before taxes, that is EBIT minus I, comes out to be 1,52,000 in plan 1, 1,12,000 in plan 2 and 52,000 in plan 3. Tax rate is 50%. So, this is 76,000, 56,000, 26,000. Earnings after taxes are also 76,000 for plan 1, 56,000 for plan 2 and 26,000 for plan 3. Now, we can find the number of equity shares. It is equity capital divided by price of each equity share. So, in the first case, how much is equity capital? Because the total capital is mentioned as the firm needs 10 lakhs, right, out of which 1 lakh is through debt. So, remaining 9 lakhs will be through equity. So, 9 lakh divided by 25, right. How you got this 25? It is mentioned that the share price is rupees 25, right. So, 9 lakh by 25 comes out to be 36,000. For plan 2, the company has used 4 lakh of debt. So, remaining 6 lakh is through equity and the price per share is 25. So, this comes out to be 24,000 equity shares. In plan 3, you have to pay attention. The company issued 6 lakhs through debentures and the remaining 4 lakhs is through equity. But it is mentioned if the company uses more than 5 lakh of debt, right. It is mentioned if the company uses more than 5 lakh of debt, the market price per share drops from rupees 25 to rupees 20. So, we have to take this into consideration. So, 4 lakh divided by 20, this comes out to be 20,000. So, using these values, we can find the earnings per share, which is earnings after taxes divided by the number of shares. So, for plan 1, this comes out to be 2.11, for plan 2, it is 2.33, For plan 3 it is 1.3. As the company has an objective of maximizing earnings per share, alternative 2, right, that is raising a debt of rupees 4 lakh and equity of 6 lakhs would meet the objectives. The EPS is highest under alternative 2. So, we have seen if a company uses the debt moderately, the EPS has increased, but if company uses excess amount of debt, what is happening? There is a fall in EPS, right. So, as per this, the company should go with plan number 2, right. So, these are the list of the books which you can go through to have a better understanding of the concepts. Thank you so much.